Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It is Tuesday, June 20th, 2023, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, I see futures are down roughly about 1/3 of 1% across the board. We saw a little bit of a reversal on Friday after a lengthy advance. Whether or not this, morphs into a little bit more selling remains to be seen. But I can tell you historically, the next week to 10 days is pretty bearish in terms of the annualized return, average annualized return that we see on these upcoming days. I would say probably next week or so. Usually we do finish the month of June off strong, and we tend to head into July with some strength as well. So I think in the short term, I think this week, I think the market is vulnerable. I haven't changed my position one bit. I remain extremely bullish. I believe the market's going a lot higher. But in the short term, I do recognize we're overbought. I also know it's the week after options expiration. We didn't really see much selling with Max Payne last week, but sometimes we do see it in the week after. So don't be surprised to see some selling this week based on options, based on historical tendencies, and just based on the simple fact that we're overbought. We've had such a huge run to the upside. So very bullish right now, but also cautious in the near term. So I think you have to be a little bit careful. Cautious to me means stay away from leverage. On the long side, I don't think that's a smart move. It could turn out, market's been going up, maybe it keeps going up, but you have to evaluate risk. And for me, I think we could be in for some additional risk. Let's go through today's agenda. Going to start off today with the daily market recap, talking technically, chart of the day, blog highlights. I wrote a couple blogs over the weekend to go through those, talk about that a little bit. Earnings spotlight, then we'll wrap up with the 3 you must see. I do want to talk a little bit about a special that we've got going, but first, let me point out a couple of charts. These were really a couple of key calls that I made back in to start 2022. That'll be the first one I show you here. You can see this article I wrote. This was actually in Chart Watchers, and it was written on New Year's Eve and published almost 8 o'clock at night. That doesn't tell you a little bit about how passionate I am about the stock market. Here I am on New Year's Eve writing, about what we might be looking at in 2022. But it's what I do. I love to follow the market. I love to research. And what I pointed out going into 2022, number one, we had inflation issues. Everybody was aware of that, but that was a problem, and that was going to continue to be a problem until we started to see some headway. So that I pointed out in the article. Also, I mentioned that when you've got problems with inflation, you generally are going to see it in terms of the relative underperformance of growth stocks. And this was just the chart going into 2022. And throughout 2021, we saw small cap growth stocks underperforming small cap value. And that continued into the first several months of 2022. So that was another thing to be aware of. And then finally, this was really the big one. This was, I won't say it was the nail in the coffin, because I think the nail in the coffin for the stock market to open 2022 was sentiment. Sentiment was off the charts. And I talked about that a lot. But here, I had pointed out this is the performance in the month of December 2021. Now, the S&P 500 during this period moved to an all-time high. It ended January and started the beginning of ended December and started the next month, January 2022, moving to all-time highs. But if you look at what was happening under the surface of the market, and I think this is the part that a lot of folks don't pay enough attention to, but this was a clear telltale sign that the market, you had to be cautious at least. I'm not going to say outright bearish, because you need to start to see the major indices start to roll over, and we were at all-time highs. But this was a major warning sign. Look at consumer staples during the month of December 2021, gaining 10.5%. Consumer discretionary, on the other hand, which is the more aggressive part of consumer spending, consumer discretionary sector was flat. Now, if you don't follow the market, then maybe it's no big deal. But if you follow the market and you understand the way the market works, it is very rare that you ever see 1 month this type of divergence between consumer staples and consumer discretionary, with consumer staples leading during a bull market. Now, I mean, if you have a outright bear market and the market's getting trounced to the downside, then yeah, sometimes consumer discretionary will underperform consumer staples by a wide margin. But this was when the S&P was actually setting a high. Money was rotating into defense. Look at the top 4 sectors: consumer staples, real estate, utilities, healthcare. When you're breaking to all-time highs and you're doing so with strength in those 4 areas, that's a problem. That's a big problem. So the only thing I said is, hey, the market is setting up for a difficult period. And then I went on a week later at Market Vision 2022, and I highlighted what I thought could morph into a cyclical bear market where we could see 20 to 25% down. That was before it all started. Then for my YouTube video, of course, this was, we're having an anniversary special that ends tonight, which I'll talk about in just a second. But this was June 16th, 2022, right when we established that initial bottom. We did ultimately go back down slightly below in October 2022. So for those who want to criticize that bottom call, feel free. But I think it was a great call. And I think the double bottom call at the end of September was also good. It was the opposite. What I just showed you in this blog article, how money was rotating into more defensive areas, that's a sign to me that Wall Street, the big Wall Street firms, are prepping for something that they're not telling us about. Everybody's cheerleading all-time highs, but under the surface, you could see things weren't all okay. We had problems. Well, when I called the bottom in June of 2022, I was seeing the opposite. I was seeing money beginning to rotate into aggressive growth areas. Very unusual. We saw sentiment begin to reset finally, where sentiment had been so extremely bullish heading into 2022. It actually finally started to turn more bearish when we got to May and June of 2022. That helped. We had divergences that started looking much more positive. That helped. The rotation in the various groups, the sectors, was starting to give us different signals. That helped. It's looking beyond what you just see on a chart. And hey, I'm a technician. I love technical analysis, but I think you have to dig deeper sometimes, especially if you want to try to uncover significant turning points in the market. A lot of times the technicals will tell you a little bit after things have turned. Oh, the PPO has just crossed back up above its trigger line. Well, that takes strength to do that. Or, the PPO's moved back up above its center line. That a lot of times will take a lot of strength coming out of a bear market. So if you wait for those technical signals, a lot of times you've already missed a big portion of the move. And history tells us that when you're coming out of a bear market, a lot of times the first 6 to 9 months, maybe up to 12 months, that's the biggest part of the move. So if you're waiting for technicals to tell you these things, a lot of times you're behind the 8 ball. So that's why we do what we do. And I want to just point out that today, Tuesday, June 20th, we started this over the weekend. We were running an anniversary special, just an anniversary of the June bottom call from last year. I think we've proved our mettle throughout some pretty difficult markets over the last 3 or 4 years, as far as our market guidance. I said right in the middle of the 2020 pandemic, March 2020 pandemic, that we were in a secular bull market, that this was not going to end the secular bull market. Later that month, I think it was a week or two later after I made that call, we bottomed, market went right back to all-time highs very quickly. Anyhow, if you want that kind of guidance, we do a day. I write a daily market report to our members every single day. The market's open. And if you want that type of guidance, you can go in, sign up for a 30-day no-cost trial, or better yet, and I'll go ahead and click on this just so you can see where this takes you. The thing is, if you fill this out, okay, we'll get you a 30-day trial. By the time your 30-day trial ends, you're not going to have this special. If you go down and you look at the annual deal, it's $997 for 365 days. So it's $997 for an annual subscription, but that's just for 12 months. Nowhere on our website are you going to see this anniversary special. What you need to do is write into us at support@earningsbeats.com. Support@earningsbeats, both plural, earningsbeats.com. And just write in the title anniversary special. We'll get back to you and we'll get you set up. And when we get you set up with the annual, we'll give you your 30-day trial. We'll give you the 30 days that come with a 30-day trial, and we'll give you 2 free bonus months. 15 months for the price of 12, and that's ending tonight at midnight. Just wanted to make sure everyone's aware of it. We'd love to have you. No one has called this market better than we have. No one. It's impossible. You can't call bear market before it starts and then literally call on the day it bottoms. It's hard to call it any better. So anyhow, if you want to check us out for the next year, this is a great time to do it. All right, the daily market recap. So what happened on Friday? Well, we did see the market reverse. We saw some selling. We saw all of our major indices finish down. Dow Jones Industrial Average was down about 1/3 of 1%. S&P also down, maybe just a little bit more than 1/3 of 1%. The NASDAQ 100 down 2/3 of 1%. And then small caps and mid caps both down about 0.4 of 1%. Transports down 0.5 of 1%. As far as sectors go, utility is the best performer. They rose a little bit more than 0.5 of 1%. But the key areas, the more aggressive areas that we've seen so much strength in for the past, well, really 5.5 months since the beginning of the year, that's where we saw a little bit of the weakness on Friday. And I wouldn't be surprised to see it continue, just because we are in a period where the market historically doesn't do well. We're in that week following monthly options expiration. That also is normally not a good sign. And so on Friday, we saw communication services drop 0.8 of 1%. Technology also up there around that 0.8 of 1%. And we're well above the 20-day moving average on both of these key sectors. So pulling back to test the 20-day would just be a normal kind of a test. And for the technology group, that would be another $8, or roughly 5% from where we are right now. So this could potentially be a week where we see some profit taking, maybe set up some opportunities as we get ready to go into potentially a pre-earnings run. Historically, we do tend to see that as well. So after this upcoming week of historical weakness that we tend to have to try to deal with, we do go into a 2-3 week period of bullishness, where the market does tend to run up heading into earnings reports. From there, that's when things can get a little bit dicey. And we'll be talking about more of that as we get closer. But for now, be careful this week, knowing that we have potential for some more gains ahead based on the history of pre-earnings run-ups. But right now, a little overbought, well, a lot overbought in some areas. And we could see some rotation. I think that's going to be more the key this week. To me, it's not whether communication services and technology sell off, because they're due for a sell-off. The question is, does everything sell off? Do we see all 11 sectors going down, all the major indices going down? You know, key areas like transports going down, semis going down. If everything goes down, then obviously the market is taking more than, it's more than just a little bit of rotation. We're actually seeing some distribution, and that we'd need to monitor. But more bullish action would be selling in technology and communication services and those types of areas, maybe consumer discretionary, industrials, and seeing money rotate into other areas, even the defensive groups. Because remember, rotation from aggressive to defensive is not a bad thing when the market is pulling back. It's a bad thing when the market's going up, because it's just giving you a signal that the Wall Street firms are repositioning into defensive areas while the market's going up. That's not a good sign. But if you're pulling back, the tendency is the groups that led you during the run up, the aggressive areas, technology, discretionary, those types of things, those sectors tend to pull back and money rotates in bullish fashion into other areas. We could see energy and materials lead, which would be fine. But that would just be an indication that money really isn't leaving the market. It's just rotating. And that is the hallmark of a bull market. So that's what I'll be watching for. Looking at industry groups, first of all, I want to just point out that gold miners broke back above their 20-day moving average. We have this kind of a double bottom in play. We had a little reaction move to the upside back at the end of May, early June. And then we pulled back down, looked like maybe we're just going to roll back over and go to new lows. And instead, gold broke back up. The miners broke back up above the 20-day moving average, closing at 103.44, which was a little bit more than $1 above that 20-day moving average. I could see this group, especially if the market's weak and we see volatility pick up a little bit. I wouldn't be surprised the VIX maybe moves back up. We could see 16, 17, maybe a little higher on the VIX if the market sells off for a bit. But rising VIX tends to be a good thing for areas like gold. So I wouldn't be surprised to see if we have that selling in the key aggressive areas. This might be an area that gets some of that rotation. Medical supplies in the defensive healthcare area broke out. This is I'll show you this chart a little bit later, but this is an ascending triangle off of an uptrend that broke out. That's very, very bullish. So don't be surprised to see some money moving over into that area. Meanwhile, renewable energy, not so strong, down over 2% on Friday. Moving back, it looks like we've got this gap area to fill back near 350, and we finished at 363 beneath both the moving averages. So another 3-4% would get us pretty close to that gap support level, and then maybe watch the renewables to see if we have some money coming in at that point. The 10-year Treasury yield. Let's pull up this 10-year Treasury yield. Take a look. This morning it is down 3 basis points to 3.74%. So we're sitting at 3.77 at the end of last week. The 20-day is at 3.71. That's been holding. So let's see if on any further weakness in the yield, do we hold that rising 20-day EMA? If we don't, then it's just more sideways consolidation. And at that point, I would say probably this is a double top and we're rolling back over. That would be at least my initial thoughts. We do have a slight negative divergence here in the 10-year Treasury yield. The yield did move to a newer high, or a higher high, last week. At least recently, it was a higher high. And notice the PPO is lower. So a slight negative divergence there. If you lose the 20, it just starts to look like more like we might see a drop back to that 360 area. All right, next up. Oh, by the way, the May housing starts and May building permits will be out later this morning. We don't really have a whole lot going on this week, which is another thing that could maybe have the market focusing on something probably not that meaningful, but if it creates a little profit taking, it might fit right in with the agenda for the week. But anyway, housing starts due out later this morning. The estimate is for 1.4 million units. April, we had 1.401 million units. So pretty much we're looking for status quo there. April and May look to be coming in pretty similarly. We'll see. May building permits, however, expected to increase a little bit. April was 1.416 or 1,416,000 units. And that's expected to jump in May to 1,433,000 units. Now, a lot of these housing reports, you have to be careful. I mean, we're talking about looking back at May, housing starts and building permits. We're already into the second half of June. I mean, we're honestly not far from moving into the second half of the year, and we're still talking about what happened in May. So the stock market looks ahead, and a lot of these economic reports lag. So There might be an initial reaction from some of these reports, but I really don't think that they carry a whole lot of weight in terms of what the market sees going forward. So based on that, I would just not put a lot of weight in whatever happens later today when the housing starts and building permits number comes out. All right, so let's move on to talking technically. S&P 500, there's a little bit of reversal. Now, if you look, you see the heavy volume. Let me just warn you that there are 4 monthly option expirations that carry significant volume. They're called quad witching days. Just a lot of different contracts, options that expire, and a lot of times get rolled over. Anyway, there's a lot of volume that normally is associated with those days. It's always March, June, September, and December. So if you look at the volume here on option expiration day in June, you see over 4 billion shares. Look at March, over 5 billion shares. Look at December, 4 billion shares. Look at September, 3.5 billion shares. Those 4 days are all in the top 6 or 7 for the year in terms of volume. So I wouldn't read too much into the volume from Friday because that's typical. Instead, I would just be looking at, hey, 44.50, 44.48, we set a high. And that short term, I think, could be a significant number to watch. In other words, I wouldn't be surprised to see some selling. I don't know if we go back to the 20-day or we start to work our way, but that would be kind of my thought, would be to go to the 20-day. I think even potentially we could move back down to around 41.75 to 4,200. That wouldn't surprise me just because we've had such a big run up. So a pullback into that area shouldn't be too surprising. And that's why I wouldn't be in leverage, just because I think that we do have downside risk in the near term. And if you're riding on leverage, that can get more painful. So if you're in something like the QLD that tracks the NASDAQ 100 at a 2-to-1 clip, or the TQQQ, which tracks it at a 3-to-1 clip, I personally, for me, I would just maybe consider getting out of the leverage and just go with the QQQ. If it goes up, you're still making money, but you're managing your risk better, because if it goes down, that TQQQ is going to get hit. If the NASDAQ goes down 3, 4, 5%, then you're talking about maybe 10 to 15% on those leveraged ETFs, which I would be careful. Now, if we start seeing a pullback back close to the 20-day moving average, that is when, from a bullish perspective, I would tend to get more. I would be thinking about taking on more risk. And so at that point, getting into something that's leveraged makes more sense to me, but not while we're stretched. And I said the same thing last week. Market kept going up. It doesn't bother me whether the market goes up or down. It's about just being aware of the risk that's out there. And I do think there's a lot of risk going into this week. All right, NASDAQ 100, pretty much similar. I do like the fact that the PPO continues to put in higher highs. Remember last week as we were breaking out, I know I was telling members, I don't know if I mentioned it on my shows, but as we were making this breakout, we had a slight negative divergence, but you have to, sometimes people pull the string too soon and say, oh, negative divergence, we broke out with a negative divergence. Anytime you're in an extended uptrend and you break out again after even just a short period of weakness, a lot of times you'll see a slight negative divergence. You got to give it time to see if that's a new rally or if it's a failure. So I usually wait for a reversing candle. In this case, we kept going up, up, up. We had a new high on the PPO. So as far as I'm concerned, momentum is still extremely bullish, meaning any kind of a pullback to the 20-day is normally a great entry point. So, or maybe a re-entry point in terms of leveraged ETFs. All right, move on to the chart of the day. One more time over to earnings beats, because for those of you who like this chart of the day, or that like just having an idea or an educational piece a few times a week, you probably would love our earnings beats digest. It is published 3 times a week, Mondays, Wednesdays, and Fridays. It's a very, very quick read. I don't want you to think you're getting something that's going to take an hour. I'm talking about 2 paragraphs in a chart. Very simple, yet educational, could be a trading candidate, could just be something to be aware of, something taking place in the market. It could be sentiment. A lot of times I'll look at sentiment. So it doesn't always have to be a PPO or anything like that. It could be a gap. Things that are really important on a chart that we like to focus on. Anyhow, name and an email address is all it takes. Hit that subscribe button. We'll make sure you get set up. There's no credit card required for this, by the way, and you can unsubscribe at any time. So this Earnings Beats Digest, a great way to go to get to know us a little bit better. Also, we do free events, and we're going to have one coming up in a few weeks. And anybody who's on our Earnings Beats Digest newsletter, if you've subscribed, we'll reach out to you and give you room instructions for all of our free events. So it's another big reason why you want to be part of that community. All right, so what's the chart of the day? Well, we normally do our charts of the day Monday, Wednesday, Friday. We actually did one today for our community because yesterday, of course, was Juneteenth day, so the markets were closed. We don't when the market's closed, we take a day off. Well, I still work a little bit, but for the most part, we shut down our operations. So we decided to do maybe a special little Earnings Beats Digest article for today, and it featured the medical supplies group. And actually, we're getting really close to the end of time, so I'm not going to be able to get through everything today. But anyhow, this was an ascending triangle that broke out. That's very bullish. Need to be aware of that. I see this group going higher. Blog highlights. I just wanted to talk about the call that we made a year ago. I think it's really important to look at what the market looks like now versus what it did look like. I mean, now we're going up as opposed to a year ago where we were in the midst of going lower. Next, the German DAX and the S&P 500. I wrote an article talking about which way the dollar's heading. Make sure you check out this article. I think it's a very educational piece on what we need to look for in terms of the relationship between these two indexes, two countries. And then earnings spotlight, I just wanted to mention FedEx is reporting after the bell today. We are seeing some relative strength in the stock relative to its peer group, but its peer group has been awful relative to the S&P. So it's kind of a pig with a pink lipstick kind of a thing, where the group's not very good, but this one looks, made up really nicely. So we'll see what happens with FedEx after the bell. The three you must see, I'll go through real quick. Ball, big move up. Got to get through about $61, $62 to really make this potentially stick to the upside. Next up is GLW, and that is Corning, making a big move at the end of last week, actually all last week. Double top up here around 36.5. Still got a little bit of work to do to get through there. And the last one I have for you is Roblox Corporation, also making a move. Short term, though, we've got to get a close above about 42.5. Then we've got gap resistance at about 45.5. So some work overhead to do with Roblox. All right, that's it for me. I appreciate everybody tuning in. Make sure you check out that 1-year anniversary special. Love to have you over at Earnings Beats. Have a great day, everybody. Happy trading.